one thing that started happening is I started seeing all these kids, like young kids, 18 to 22, talking about day trading. And they're like, showing their returns and telling people how to make more money day trading. It was a little alarming. Like, I think after like the 9th or 10th one, I was like, we need to do a video on this. Because day trading is definitely has a lot of hype around it right now. I totally get why people are allured to it or why it's easy to attract people. But day trading is something that everyone should avoid.
So, what is day trading and why should you avoid it? Day trading is when people buy and sell stocks quickly, all within the same day. The goal is to make small profits from price changes during the day without keeping anything overnight. They try to make small profits in short periods of time, and over time it adds up. So, when you think a stock will go up, you buy the stock, and when it happens, you sell it with profit. And for selling, it's the same thing. But the most important difference between day trading and investing in the stock market is the approach and the time horizon. Because when you invest, you put your money into companies that are expected to generate profits over the long run. And here, time is your friend as it allows your investments to grow with the market. But day traders, on the other hand, do something very different. For a trader to win, they must identify misprices in the market that others haven't noticed. With all the data and advanced algorithms in today's markets, this is extremely challenging in such highly efficient markets. So, therefore, I compare a trade to buy or sell something with a blackjack table just to show you how things works with buying and selling. Every time you buy a stock, someone else is selling, right? So in every trade, you have one winner and one loser, correct? But this is the important part. Every trade comes with cost. Costs like trading fees, bid ask spreads, and taxes, for example. And this is the reason why you will lose money on the long run. And the more you trade, the higher the costs. And even if you are correct 50% of the time, the coupier's cut the transaction cost will cost you money. So when you look at blackjack, for example, we all know the house always wins in the long run because the odds are slightly in its favor. So you could say that the longer you stay at the table, the more likely you are to lose. And this is why day trading, especially for beginners, is often a losing game. The same applies to frequent trading in the stock market. It shifts the odds against you.
This is why you should stay away from day trading. It is so risky. I mean, we were talking about earlier about day traders liking volatility. They're trying to buy or short during these swings. Well, in those moments, it's impossible to get it right every time. And getting it wrong one time, you could lose big. Actually, if you look at the stats, right, 80% of day traders end up unprofitable or losing money in 12 months. And in that 12-month window, the average is a 36% loss. So out of 10 people watching this, and you're like, I want to start day trading, 8 of you are going to lose 36% of your investment year one. That is terrible, terrible odds because we're talking about gambling. So that is not in your favor. And then on top of that, 75% of day traders quit in the first 2 years.
So the more you trade, the more likely you are to lose. And this is what famous investors have to say about day trading.
There is this feeling among some just Main Street investors, if you will, who are telling me, look, I feel as though high frequency trading is really taking over this market and I can't play in that game. What would you say to them? I mean, how much of the volatility over the month of August would you attribute to high frequency traders, and what does it do to the average investor's ability?
Well, average investors should absolutely, as they say, I can't play in that game, was I think the quote you used. They shouldn't play in that game. It's like going to Las Vegas and gambling. Why would anybody want to do that when you know that the house takes more than the winnings than the winners and losers combined? It's not a zero-sum game. It's a loser's game, whether you're at the racetrack or at the state lottery or in Las Vegas. Ultimately, you lose. pick your stock market, pick your bond market, pick your stocks even if you buy a very diversified list, and then get out of the game because you can't play it. It's the cards are really stacked against you with this high frequency trading, and we should be looking at long-term investing, the wisdom of long-term investing, Poppy, is the way I'd express it, and just ignore the folly of short-term speculation. It's absolutely a loser's game.
And here is why investing works differently. You buy shares in a company and wait for it to generate profits, allowing you to benefit as a shareholder. Historically, we know from the data that over the long run, markets go up 75% of the time and go down only 25% of the time. So time becomes your ally. It smooths out short-term volatility and eliminates the drag caused by transaction fees. So long-term investing isn't about gambling on the market's direction tomorrow. It's about participating in the growth of companies over the long term, and if the company grows, it makes a profit. And when it makes a profit, you benefit as well. But platforms like Robinhood make trading easy for everyone, but they also encourage risky behavior, which often leads to losses for most people. And there is a lot of evidence why retail investors underperform. For example, a study titled Attention-Induced Trading and Returns looked at retail investor behavior on the Robinhood platform. The findings reveal poor performance of popular stocks. The most purchased stocks on Robinhood lose an average of 4.7% in value within the next month. Herding behavior. Many users buying the same stock leads to minus 3% abnormal returns within 5 days for typical cases and minus 6 returns within the 5 days for extreme cases. But it doesn't stay there. There is also a study from 1998 where Professor Terence Audien analyzed 10,000 trading accounts to uncover why retail investors underperform. The findings is that investors trade too much too often. Retail investors frequently trade what leads to costs that erode returns. They often sell stocks that do well later and buy stocks that don't perform as well.
I think it comes down to technology. You have all these online brokerage accounts, you have investing apps. The accessibility for a lot of people to participate is it's available now. And then you mix that with people selling the dream. You have, the TikTok and YouTube influencers showing you how, or the appearance of how rich they are and all these returns. And all of a sudden you start asking yourself, oh my gosh, can I make that much? Can I get rich? And then they tell you, I'll show you how to do it. You're like, yes, I want it, right? It's exciting and it feels more like gambling. Your blood's pumping. You're getting like a dopamine rush. Those are all indicators that you are not investing. You are gambling. That is what we're trying to stay away from.
And I have seen clients struggle a lot to sell an investment because they didn't want to accept a loss. And that's why you need to be cautious with day trading and skeptical with people who claim you can make a lot of money from it in the short term.
So simply put, day trading is basically the equivalent of a get-rich-quick scheme. That's why they sell you the dream so hard. You see a 25-year-old driving a Lamborghini talking about stock trading, going, I'll show you how to do it. Red flags there. The easiest way to make money is to tell people how to make money. And whenever they're telling you that you can get rich quick, that's a good sign that you need to stay away from it. And remember, there's a difference between being wealthy and being rich. Being wealthy is a marathon. This is a long-term play. Getting rich is a sprint. So anytime you see something we're talking about getting there quick, it's short-sighted.
And this is why modern trading platforms and social media make things worse. Influencers often push risky strategies like trading options, which can lead to bigger losses. Stocks that go viral online usually do poorly because they are based on hype and not on solid research. So if you are curious about making money and want to avoid the sprint, focus on the marathon instead. It's a smarter and faster way to build lasting wealth. Please be sure to watch this video where I explain the 3 ETF portfolio that can make you a wealthy person over time over the next 30 years. So see you in the next video.